The financial disruption incepted by the US subprime mortgage crisis spread to a number of other advanced economies in the summer of 2007. Such crisis originated from a bubble exacerbated by new kinds of financial innovations that arguably disguised real risk, widespread failure by market operators to comply with their own internal or corporate risk management procedures, and regulatory as well as market operators' failure to prevent assumption of excessive financial risk exposure. Starting in 2003, one of the main causes of US housing market rapid expansion was that interest rates were extremely low. The rapid rise of lending to subprime borrowers, that are people consider higher than normal credit risk, helped inflate the house price bubble. The sustained rise in housing prices, along with financial innovations, suddenly made subprime borrowers, previously with no significant access to mortgage markets, attractive customers for mortgage lenders. This new group of eligible borrowers increased housing demand in the real estate marketplace, thus helping inflate home prices. Those new financial innovations thrived in an environment of easy monetary policy by the Federal Reserve and poor regulatory oversight. By 2007, as interest rates rose, borrowers began to default. There are plenty of hypotheses about what caused the global financial crisis, ranging from greed to regulatory failures. However, very few will dispute that there was just a single cause of the crisis. Even though the collapse of the subprime mortgage markets in the US was the trigger of the crisis, it is now universally considered that a combination of factors contributed in the origin and severity of the crisis. Some key factors include expansionary monetary policies in the major financial centers, developments affecting the subprime mortgage markets of US, poor assessment of risk in the financial system, lax regulation and supervision by government authorities caused by failed and inefficient markets, and last but not least, global macroeconomic imbalances. This is the reason Mr. Bernanke, the former chairman of the US Fed, formulated the global savings glut theory. According to this, outside the US, exchange rate and other economic policies followed by emerging markets such as China contributed to the United States' ability to borrow cheaply abroad and thereby finance its unsustainable housing bubble. Thus, Bernanke posited that the global savings glut, rather than particularly unusual factors in the United States, drove the imbalances. In particular, he assigns only a minor role to monetary policy. Although the global financial crisis was not a one-time event caused by lax regulations, and undoubtedly there is more than just an easy monetary policy by the Fed behind the creation of that major housing bubble, it should have been possible for regulations and regulators to be less lenient. One enduring question about the financial turbulence that engulfed the world starting in the summer of 2007 is how come that problems in a small corner of US financial markets could infect the entire US and global, especially European, banking system. Europe's debt crisis was initially triggered by events in the American banking sector. The collapse of America's fourth largest investment bank, Lehman Brothers, scared other banks and investors with which it did business. The fear that more banks could fail caused investors and banks to take extreme precautions. European banks that had invested heavily in the American mortgage market were hit hard. In an attempt to stop some banks from failing, governments came to the rescue in many EU countries, like Germany, France, the UK, Ireland, Denmark, the Netherlands, and Belgium. However, the cost of bailing out the banks proved to be very high. As Europe slipped into recession in 2009, a problem that started in the banks began to affect governments more and more, as markets worried that some countries could not afford to rescue banks in troubles. What started as a banking crisis became a sovereign debt crisis. Furthermore, as recession began to bite across Europe, the focus on the health of government finances threw a spotlight on the fact that a number of governments in the Eurozone had been borrowing heavily to finance their budgets for years, accumulating huge debts in the process. Finally, some governments had ignored the rules designed to make the euro work. All of this prompted questions as to whether the institutional setup of the economic and monetary union and the euro was adequate in times of crisis. In fact, despite a common currency, underlying structural problems of price, competitiveness, and productive capacity persist within the eurozone and have intensified under market strain. In the US, the Fed responded to the crisis by taking ordinary and extraordinary actions to boost economic growth and to achieve its congressionally mandated goals of maximum employment and stable prices. Beginning in September 2007, in a series of 10 moves, the policy rate was reduced from 5.25% to a range between 0 and 0.25%, where it has remained. Then the Fed embarked on serialized purchases of Treasury and mortgage-backed securities, a policy popularly referred to as quantitative easing. Between 2009 and 2014, the Fed engaged in 3 rounds of QE. The third round was completed in October 2014, at which point the Fed's balance sheet was $4.5 trillion. In September 2014, the Fed announced plans for normalizing monetary policy after QE, explaining that it will raise interest mainly by raising the rate of interest paid to banks on reserves. At present time, the economic situation in Europe is quite thorny. The 2007 financial crisis evidenced the weakness of the Eurozone. The European Council had to come out with different strategies and policies to save countries that were forced to bail out their own national financial. However, traditional monetary policies proved to be ineffective to the financial markets, obliging the president of the ECB, Draghi, to declare in 2012 that the ECB is ready to do whatever it takes to preserve the euro. Then, he approved the outright monetary transactions to buy bonds in the secondary market in order to shield the excessive interest rate spread between creditor members and indebted ones. Finally, on 9 March 2015, the euro system started to purchase bonds issued by euro area central governments and international or supranational institutions. The ECB's decision to adopt quantitative easing in the eurozone was the right one. However, monetary policy alone cannot be called on to overcome the crisis. A sustainable resolution to the crisis lies in the hands of member states. Substantial structural reforms and austerity measures are needed in struggling countries. There is no other way by which ECB policies will effectively work, and without all this, the ECB will not turn Europe's economy around.